any number northward of 6,000, 6,500 crores. I will not put a number on QIP, but just theoretically talking about it. And so basically between these two events itself, actually I become debt zero, forget net debt. I'm still assuming that our sales will pick up. We have done gross bookings of about 650 crores in the last quarter. As we speak right now, the momentum continues, but again, I would still allude to a conservative guidance on that. So to achieve debt zero in next 12 odd months is not an issue at all.
And
coming down to DCCDL, I think we have a gross debt of about 16,000 crores over there. For the year. So our debt number over there will be pretty much the same at the end of the fiscal year. We still have to complete some of the transactions inter se between the two entities. I would be actually once we complete that, or once we actually have an agreement with GIC in the mechanism in which it will get done, I think I'll be better able to guide you on the net debt number on DCCDL. But as on date, our internal workings show that the number should remain pretty much flat with the assets going over there.
Okay. I have a few more questions, but I'll come back in the queue. Thank you.
Thank you. Next question is from the line of Abhinav Sinha from CLSA. Please go ahead.
Hi, sir, couple of questions. So firstly, we got cut off, I think, somewhere when you were explaining that cost will also come down. Can you please repeat that point?
So I was talking about construction debt for construction today, which is at about 9.25. We believe as the balance sheet continues to improve, my credit rating would go up, and hence my cost of debt in my DEFCO will continue to decline. That's what I was alluding to.
Okay. And we will also expect some reduction in the SG&A and employee cost also, right, for DLF as such?
Yes, you will of course see that for sure.
Okay. And so secondly, on the financial liabilities with DLF, so there's this amount to be settled between DLF and DCCDL. So when you're talking 5,500 crore net debt, it excludes that, right?
Absolutely, because it's not the nature of a debt.
Right.
It gets categorized in the balance sheet, but it is something which is already been understood and agreed between the two partners, which is DLF and GIC, as to how this will be settled. So we have given ourselves enough time for those assets to get transferred from DLF to DCCDL. Do note, I mean, what we are trying to achieve in DCCDL is a platform play. So we would ideally like all our rent yielding and all our commercial lands all being parked into DCCDL. In some cases, we cannot do that because of regulatory reasons. Otherwise, ideally, other than our corporate office of DLF Limited, we would like to transfer everything over there. And that is also something which is accepted by GIC, but of course, we need to sit down together and work out the mechanics.
And is there a gearing limit till which DCCDL will go?
Well, the gearing will actually keep coming off. If I can't show you the whole business plan of my next 10 years, when we're talking about, creating free cash in excess of about 1,000 odd crores every year as we go forward, which is more than enough for my development of new assets, and the renters increasing at about 5% every year, you're talking a very compelling number of EBITDA in 10 years' time. So we expect the EBITDA to be northward of 5,000 odd crores in this period of time. So the gearing will continue to come off. If there is an opportunity to scale up construction within DCCDL group, yes, both the partners are fully aligned to looking at it. We are also aligned to looking at any inorganic play to further utilize that free cash flow. But if both such opportunities are not there, then obviously the gearing will come off and the distributions to shareholders will increase.
Okay, thank you.
Thank you. Next question is from the line of Abhishek Bhandari from Macquarie. Please go ahead.
Yeah, good evening to the management team and congrats on, successful closure of the GIC deal. I had two questions. Pardon me if the questions sound very simple to you. The accounting entry what you have made for recognizing the gains, deemed gains on, disposal of your controlling stake in DCCDL, is it fair to assume that it is just an accounting entry and there is no cash associated with it? And a related question is that how does this 4,000 crore of deferred tax liability which you have created on your balance sheet, get settled over a period of time?
Okay. So Abhishek, your answer to your first question is an absolute unambiguous yes. This is completely on account of it's an accounting entry at the consolidated balance sheet level, not at a standalone level. And basically the reason because of some accounting standard under Ind AS gets triggered off is because the status of DLF or of DCCDL is changing from a subsidiary to a joint venture. So basically it amounts to what in accounting terms is known as a loss of control. Because now it will be treated as a joint venture, not as a it's a subsidiary. So broadly, I'm telling you very simplistically. So if GIC paid 9,000 crores for the 33% stake, basically DLF's stake gets quote-unquote revalued at 18,000 crores. However, the net current assets value of the Cyber City was say 8,000 crores, which will no longer be there since it will not be consolidated. So the balance 9,900 odd crores becomes like a pre-tax gain. And then there's a long-term capital gain liability applied on the 17,000 crores of the gross number, which is the 4,000 crore number. So since neither of these two entries are in that sense, quote-unquote, entries in the real standalone world of accounting or tax, there is no tax liability that can be triggered off. However, if ever there is a hypothetical situation when DLF does actually sell Cyber City's stake for a value, whatever it be, then the tax consideration of that, you can say 4,000 crores of that has now been recognized in the deferred tax liability at the console level. But no tax payouts happening today.
So this is only at the console level and not at the entity level. And for reference, you can look at Ind AS 110 as to how this is all, how it all plays out.
Sure. So that's really helpful. Second question is, on your slide number 20, where you have mentioned even in your opening comments that around 9,300 crore, which is sitting as advances from DCCDL and recognized as DLF's loan, will be paid by DLF Group to DCCDL over a period of time by selling certain rental assets and land parcels. So my question is that if you could just give some sense of where these land would be, mostly in Gurgaon and Chennai, where you're looking to transfer to DCCDL, and which assets you think would go. You may not name them, but a quantum would be helpful.
Yeah, thanks. I won't name them for obvious reasons, but we have two yielding assets in Delhi and one land parcel which is contiguous to an existing project of DCCDL in Gurgaon, which is right next to the Mall of India, Gurgaon. So that is another parcel. And we have another parcel of land which is, again, contiguous to the Cyber City campus. Again, this is for a fully integrated development as we go forward. And last but not the least, in Chennai, we have few land parcels which we intend to discuss with the GIC. We have, they are in full knowledge of it, and this has been part and parcel of an ongoing discussion that we had over almost 1 year during the closing of the transaction. There's nothing that is springing up right now. There's full alignment between us and them as to how these will get transferred into DCCDL.
Though, I mean, just a caveat that obviously a detailed techno-commercial discussions will need to take place with the partner before a consummation of these takes place.
So it's fair to assume that 235 million square feet, what you mentioned on slide 8, will see some kind of modification once, these deals are finalized with the DCCDL group.
Absolutely.
Okay. Thanks a lot, sir, and all the best for the coming year.
Thank you.
Thank you. Next question is from the line of Kunal Lakhan from Axis Capital. Please go ahead.
Yeah, hi, good evening. In your presentation, you mentioned that you will be looking at launching newer projects and create new completed inventory, which will be basically in pace with the sales of current completed inventory. Any color on the new launch pipeline for Q4 or FY19 would be very helpful.
At this stage, there is only one which we have already highlighted to you, which is where we have begun the process of construction at the Midtown project, which is next to our existing project, which is Capital Greens. Incidentally, this is a project which is in joint venture with GIC. This will be developed in phases, but the process has already begun on the phase 1 of it. As we said earlier, we will be only doing construction at this stage, and we will open up sales only after substantial amount of construction has been achieved. For us, actually launch has no meaning now, other than that what inventory is getting completed 3 to 4 years down the road.
Sure. Secondly, just a related question to the previous participant. You mentioned that there are certain land parcels you've identified to transfer to the DCCDL group. So DLF will look at cashing out these land parcels, or this will be basically adjusted towards your equity investments to be made in the JV going ahead? Because the reason why I'm asking is because the DCCDL as such generates a decent amount of cash flows, which can take care of the equity portion of the capex going ahead. So just wanted to understand what will be the thought process. Will we look at cashing out these land parcels?
So we are cashing out to the extent of my payables to DCCDL up to 9,300 crores. That is an immediate process we have already undertaken. Other than that, there is nothing which is in our pipeline of encashing assets. DLF will continue to do whatever it has to do, and DCCDL has its plate full for their own development. What I said is that the arrangement between GIC and DLF is a very open, non-exclusive relationship. If tomorrow I'm developing a commercial project which I believe will add a lot of value, and let's say GIC does not believe that it adds value, I'm free to go and develop it. Once it is mature product, I can again offer it to DCCDL to buy it off me. That becomes like a business trust. So, that's what I'm alluding to, that the flexibility is there. But at this stage, over the next, let's say 12 odd months, we only have one task, is to complete the transfers of the existing yielding / land parcels to settle the 9,000 odd crore of payables from DLF to DCCDL.
Sure. And then one last bookkeeping question. What is the balance cost to be incurred on the ongoing portfolio, residential portfolio?
I think about 2,500, 2,000 odd, somewhere between the 2,000 to 800. Yeah.
And receivables against it?
The receivables I think that we have right now also they're all receivables, and the balance construction costs are they're almost matching. I think it's about 2,500 of receivables and about 2,300 of construction costs.
Got it. All right. Thanks so much, and all the best.
Thank you. Next question is from Tanuj Makhija from Bank of America. Please go ahead.
So thank you for taking my question. So the first question is, during this quarter, promoters infused 90 billion rupees in DLF. And if I look at the consolidated debt, including that of DCCDL, the debt has reduced from 256 as on second quarter FY18 to 56 billion to about 216 billion, a reduction by 43 billion. So can you please explain the utilization of promoter proceeds in third quarter FY18?
The entire utilization of promoters' money has been utilized for repayment of my debt. Part of the debt was repaid because this promoters' money was received on December 29th. So we utilized about 3,000 crores for repayment on the same day, 30th and 31st were holidays, and the balance about 4,000 odd crores has been paid during the month of January. So till date we have repaid about 7,100 crores. Balance is held as cash in our books.
Okay. And sir, what was the construction cost during the quarter for residential and for commercial?
About 450 crores.
Okay. This includes for both resi and commercial, right?
This includes the resi.
Okay.
Resi and whatever costs I incurred for development of my Chennai AC site.
Yeah, which is also in the development.
Understood. Understood. And just one basic question. You reported very strong sales for your Gurgaon Phase 5 projects, but did not recognize revenue and income statement, despite those projects achieving more than 25% sales and 25% construction completion. So can you elaborate why did those sales not translate into income recognition?
Yeah, because the two thresholds for recognition are A, completion of 25% construction, which we obviously ticked. Second is collection of a minimum of 10% of that sale. Since most of these sales in November and December only got the booking amount because there's a 90-day period within which the customer has to complete his 10% or 15% payout. So most of these sales will actually get recognized in Q4.
Okay. Okay. And the last question is, do you believe that the sales shown in November and December of 17 are sustainable now in fourth quarter and FY19?
Well, we are hopeful of that, but I think, as I said earlier, these are still green shoots, and we'll wait and see as to how January and Feb go, and talk about it, I think, in our quarterly call for the March results here.
Sure. Just one bookkeeping question. What was the area sold in third quarter FY18?
Yes, so we'll have to tell you because now it's a large part of sales actually camellias, where actually the area computations are pretty relevant. But so,
Agreed.
give me a second.
Thanks. That's it from my end.
Basically, it's about 2.5 lakh square feet that was sold in phase 5, and a total of about 5 lakh square feet.
Okay.
500,000. Thank you.
Thank you. The next question is from Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much and good evening. So, in terms of value, how would you break up your, sales for the quarter?
So, of the gross sales of 650, 480 came in from phase 5, and 170 came in from rest of Gurgaon and rest of India.
Okay, 480 and 170. But in phase 5 was bulk of it. Okay. Okay. And by when would you start recording this JV separately?
Actually, it started from 26th of December because it was only a 5-day separation last quarter. It's not reflecting. But in 31st March, when you see the results, so actually the P&L will only be the DLF console excluding DCCDL, and the DCCDL's profit will be recognized as a single line of 67% of the DCCDL consolidated profit will be recognized as a single line profit entry.
And then so will be the balance sheet, I guess, right?
And the balance sheet will also be only of the DLF console excluding Cyber City.
Okay, okay. And by when would you expect to complete all the construction work which you are currently undertaking?
So as I think we remarked to earlier caller, we expect that all the residential construction work should be done maybe by the end of this calendar year.
What is resulting in this delay? Because I remember last time it was March this year. So.
Good point. But basically, what's happening is that the finishing price of some of these ultra luxury apartments like Camellias and Crest do unfortunately take slightly longer than what we'd like it to be. So when I'm saying this ending, actually Crest and Camellia we should hopefully end earlier than that. There are a couple of projects which are still some degree of construction remains, like Ultima in rest of Gurgaon, which also we hope should be complete by the end of this calendar year.
Okay. So basically, this 2,500 crores which would be spent over the 4 quarters.
A large chunk of it should. Some of it will obviously remain because some of the bills get paid out subsequently. Through all the final bill negotiation is a painful process, but yes, a large chunk of this should get spent.
So by at least March, 19, would that be fair number, or can it spill over beyond that as well?
I mean, from your modeling standpoint, I think that's a safe assumption to take.
So I think just to clarify over here, bulk of construction for Crest and Camellia is already completed. Okay. The payments have to be made, but which are construction-related payments. So I think by June, most of that should also get done. With respect to Ultima, a few other projects, that will continue for this calendar year by December. So basically, the construction spend will be on a declining scale rather than an upscale kind of stuff, because bulk is already got done. Payment release is something where 10% retention keeps getting released once the certifications and everything come. So that will still come under the same line item, but it doesn't mean that the construction is happening. It's only the payments are being released.
Right. And the plan to launch that Midtown Central Delhi. What is the plan there? When does the construction start in that product?
So the process of construction has already started, and I think it will gather pace in the first quarter of next fiscal year. We do not intend to do any launch of sales over there. It will, at this particular stage, our thought process is consistent with our overall strategy of completing bulk of the construction before we start the launch of sales there.
Okay. Any run rate, on quarterly basis that you will be spending on for construction?
Too early for us to give you an indication. Maybe we can chat about it in March.
Okay. That's great. That's all from my side. Thank you so much.
Thank you. Next question is from Saurabh Kumar from JP Morgan. Please go ahead.
So thanks for this follow-up. Sir, I had a few balance sheet questions. So first of all, you have taken some impairments during the quarter of roughly about 1,700 crores. So could you just walk us through what are those related to?
So Saurabh, in that sense, as we have done the game changer transaction, we also, use this time to look at all our land parcels, including some of the projects which have been launched sometime in the last 7-8 years and left incomplete, etc. So like we had 3 SEZ projects at very nascent stages of development in Nagpur, Gandhinagar and Sonipat, which obviously, in today's market were not prime SEZ locations as an example. So we have taken some impairments there. There were a couple of projects which we had begun but had been suspended due to poor market conditions 3-4 years back. So there were some interest capitalizations that were going on. They're no longer going on, but the old historical capitalizations, which again, we decided that let's impair to clear a clean slate for those projects to be redeveloped. There was one particular land parcel in Chennai, for which we had been paying lease rental for 7 or 8 years, and now finally we have an agreement with the counterparty to buy it freehold. So since it's being bought freehold at the FMB, basically a large chunk of the lease rentals that had been incurred on it really. I mean, we had 2 options. We could have capitalized it with the land cost. It would have just bloated the land cost, frankly, in that sense. So we just thought we'll again take a haircut there in terms of provisioning to get that off. So really there's been no thing. I mean, there's been no sort of a new 500 crore claim that's come because of which I am recognizing anything. Most of this is stuff that basically just ensuring that these assets are now quote unquote trimmer to be able to move into their redevelopment zone, because now the market, especially for the commercial projects, are clearly seeing a sign of pickup.
Okay, and so this Chennai parcel is a Madras race club, right?
That is correct.
Okay. So the second is essentially on your balance sheet again. So we have a receivable number of 2,200 odd crores on the DLF balance sheet. So I thought since most of the projects were done, so the nature of these receivables are what, unbilled receivables or?
Receivables.
On slide 18.
So 2,200 crores, as I mentioned earlier to I think another caller also, that जो हमारा आपकी जो है, basically we have about 2,300 crores of receivables on all the projects launched till date. This as an example, Saurabh includes the 500 crores of receivables on the sales made in Q3, which we reported. So this is all of the receivables. A lot of final statements will need to go. Some projects like Ultima are still running at the 40-45% payment stages. So really, this is the residual receivables of all of those projects across the country.
Sir, but my question is, these are billed receivables or unbilled receivables?
These are billed receivables. These are billed receivables.
These are billed receivables. Okay. And sir, this 9,300 crores which will get transferred from DLF, from DLF to DCCDL. So I note on the DLF balance sheet you have an investment property of 7,200 crores. Is that also fair valued or no?
No. These are historical valued.
So that 7,200 crores is historical.
Yeah, the 7,200 crores is the actual cost incurred. So if it's a land, it's land. If it's a capital asset like Mall of India, Noida, it's what the final value of that asset was when it was finally capitalized in our books.
Okay. And when all these 9,300 crores are sold to DCCDL, like the Chennai IT Park and all, will these contribute as profits to DLF or will they just get knocked off?
No, so they're not, exactly. So 2/3 of that will get eliminated. 1/3 of the profits will accrue as a net consolidated profit to DLF.
Okay, so only
example,
1/3 of
sell an
that.
asset for 1,000 crores and the cost in DLF books was 400 crores. So I'll make a profit of 600 crores. However, in my consolidated balance sheet, only 200 will get reported. 400 will get eliminated between DLF and Cyber City.
Okay, sir. And just one final question, sir. Like post this relaunch of Crest, and first of all, if you can get some feedback on how it has gone and what's your expectation of sitting today, what timeline this 8,700 crores will take to monetize the phase 5 at least?
That is the 8,700 crore question you asked. So in all fairness, Crest has done well ever since its relaunch. It sold about, 60 odd apartments in the first 6 odd weeks. It subsequently kept a decent clip. Honestly, these are all now an issue of what assumption one takes. I mean, on a good cycle, 8,700 crores could be liquidated across a 3-year cycle. In bad market conditions, maybe a 5-year cycle. But really, given only the fact that it's been barely 3 months since we relaunched sales, it may be too less of a trend line for us to actually project the full 8,700. But as Saurabh mentioned earlier in the call, that maybe by the time we come back for the March report outs, we'll have a slightly more data points to for us to actually project as to is it looking like a 3-year cycle or longer.
So my question was specifically on Crest. So this Crest, at least you think can happen or no? Camellias, I understand, will take time.
How many Crests are left? 230 apartments are left. Okay. Around 200 Crest apartments are unsold right now.
Okay.
So basically, it's a question of. I like to hedge my bets and not commit a number, but except that we believe that it should be between it should be a number which could, in the case specifically of Crest, could actually be shorter than 3 years also if the sales cycle is good. And if again the sales cycle sort of tanks. The one advantage what's also happening from now is that on both Crest and Camellia, since they are all now post completion, there is an inherent advantage in terms of the fact that the 12% GST is no longer chargeable on these products now.
Correct. Okay. All right, sir. Thank you.
There is one inherent attraction now in these products vis-a-vis under construction products.
Thank you, sir.
Thank you. Next question is from Samir Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks. Sir, just on the last point, or rather last statement that you said for GST. So what we are seeing here in Mumbai is that whether you buy pre-OC or post-OC, there is no difference in the MRP for the customer. But is it different for you in Gurgaon?
So if you are saying the MRP including GST and without GST,
Yes.
I think there will have to be a difference unless the project is in that extremely, fortunate situation of having its total input tax credit exactly equal to 12% of the sale price, which the probability of which is, pretty near zero. So in any other product, especially a product which is at the early stage of construction cycle, so if it's a project, Samir, where say 90% of construction was done before June 30th.
Anyway, specifically for Crest and Camellia, sir.
The Crest and Camellias so in the Crest, there is a slight difference in the Crest, but in Camellias, we believe that there would be a slightly bigger difference in terms of the pre-GST and the post-GST. There would be.
Okay, so pre and post OC rather.
GST point, it wasn't vis-a-vis Crest and Camellias. What I was saying was that a customer who buys in a post-construction property like a Crest or a Camellias versus a customer who is buying a project in the early stage of the construction cycle in the GST regime, there will be a 12%, a 12 or a substantial part of that regime, the difference. 12 minus the input tax credit will be the net delta.
No, I get that point, sir. But the question was specifically for these two because they are almost nearing completion. And so here in Mumbai, for such projects, the developer is keeping the difference. So are you passing it out to the customer, and therefore their buying price would be a bit lower, or not? That's the question.
So clearly, we have done an extremely scrupulous job of going through the entire input tax credit chain. And like in the case of Crest, the entire savings on account of the input tax credits that are being made to us have been passed on to the customer clearly. And in the case of Camellias, the final statements will be prepared in the next few weeks. So again, we are in the process of completing the entire tax chain. And so again, what will happen, frankly, is, Samir, that a project where the construction cost was 70% of sale price will have a different economics than a project where the construction cost was 20% of sale price, frankly. Because it's not a question necessarily of just of the price, it's a question of the balance between the input tax credits post 1st July vis-a-vis the output tax credit liability on the residual payments, frankly. So we are being very transparent. We aren't keeping ourselves a single rupee. We are also trying not to ensure that we don't take a hit which is undue.
Okay, got it, sir. So the other question is on the 9,300 crore company that DLF has got payable to DCCDL. So this is a very large amount. And sort of you highlighted few land parcels, next to Cyber City, Mall of India. But to match up for this kind of amount, we should be talking of hundreds of acres of land, no? So I'm a little confused that which are these assets on the book of DLF, which would total up to 9,300 crores, which will have to then transfer to DCCDL.
Well, as I said earlier, this is not just hundreds of acres of land. This is just simple, city-centric lands which are for commercial development. And there are certain yielding assets which are there in the DLF entity. Plus, there is an old contract where we are building out for DAL, about 1.6 odd million square feet of SEZ in Chennai. So it's a combination of many, Samir. Unfortunately, I can't talk very freely at this stage, because these need to be agreed with my partners before I come and divulge and broadcast it across. So I think we'll have to wait it out. But as everybody was quite disbelieved at the valuation that we got for DCCDL, I think that can be correlated that these assets are very valuable. The private parties are valuing those in comparison to what the public markets are.
So, if my memory is correct, I think in the last call you mentioned that the total rent yielding assets on the books of DLF ex DCCDL was about 500 crores, if I'm not wrong.
Yes.
So
I said that was the rentals that we are getting.
That's right. The rentals, I would say. And so does all of this so all the assets which are generating this rental get transferred into DCCDL?
No. So about 300 to 350 crores of the rentals will get transferred from that entity into DCCDL. The rest I cannot transfer because of regulatory reasons.
Okay. So if I'm not wrong, so this would be valued at whatever number 3,000 to 4,000 crores, and the rest 5,000 crores would then all be the land parcels.
Correct.
Okay. And the next question is, you used to give a fair bit of a disclosure on the sales breakup and, from project by project, the total value, the total volume and the sold inventory. You stopped giving that from this quarter.
Because we don't have more of live projects now, only one or two projects are under construction. So we thought it prudent that side won't make any sense. That's why it does not mean.
But as you mentioned, Sameer, that I think, after 650 crores of gross sales that we did last quarter, about 480 crores was in phase 5, of which about 360 crores was Crest, 120 crores Camellias, and the balance 170 crores actually split across the entire geography.
So if you want, I can tell you, the live projects that are currently there, one is Kochi, which is 500,000 square feet. One is Hyderabad we have, which is still there live, which is about 3.5 million square feet. Sales, sir, Iskandar, we have another sold, whatever it is. So out of a total about 6.85 million square feet, about 4.5 million square feet has already been sold. So about 2.5 million square feet is left. Otherwise, all these live projects are pretty much at the end stage now.
Just given that, the importance of this ready unsold stock, to our future cash flow, it would be great if you can just get that slide back in. So just a couple of more questions. One is I saw 238 crore exceptional, entry into DCCDL P&L for the quarter. What is this related to?
There was one particular subsidiary which was actually a DevCo subsidiary in the DCCDL structure. As a precursor to the game changer closure, that entity had to be transferred at fair market value from DCCDL to DLF. So this is an entry which reflects the gain DCCDL made on that account.
So while DCCDL reflects this gain, in my consolidated result, this gets washed out.
Yeah, you're right.
Okay, and sir, one final one.
Consolidated DLF financials.
Okay. So one final one. So can you just summarize for us how much is the total FSI that you have, I guess primarily residential in phase 5 right now with you, and when do you want to start the next projects after Crest Camellia?
So right now we have beyond Crest and Camellias, I think we'll have about between 16 to 17 million square feet FSI right now without any further TOD, etc. So as far as the issue of when do we start the next project, I think it's a good question, but I think let's wait for the next 3 to 4 quarters to see how the sales traction of Crest and Camellia is happening, and basically when do we quote unquote actually begin the risk of running out of saleable inventory in phase 5, and then that's when we sort of plan backwards to do it. So I mean it's clearly not on the horizon for the next 6 months for sure, and but let's look at how the sales because right now the sales that we have about 9,000 crores on current clip will take a long time to do. Hopefully the market will improve. So I mean while it's on the drawing board, I don't think we can right now speculate on when will we begin the construction on it right now.
And the 16-17 million square feet is behind Crest. It's the golf course one is all exhausted.
No. So when you come here next time, we can show you on the master plan. This is all in the integrated phase 5 area.
No. Phase 5 is all right, but I think the.
I'm not going to get into location specificity on this call for sure.
Okay, that's fine. Thanks.
Thank you. Next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, thank you, sir, for opportunity to ask the question. Sir, I was just trying to reconcile the debt number. So, at the end of 2QFY18, the consolidated entity had a net debt of about 267.9 billion. Now, if I assume that DCCDL is consolidated for a moment, at the end of this quarter also, the debt should have been about 220.7 billion. So ideally, on a like-to-like basis, the consolidated net debt should have declined by about 47, has declined by about 47 billion. But it should have declined by much more because promoters did infuse about 90 billion in the quarter. So there is a gap of about 40 odd billion rupees. So I mean, can we throw some color why there is this big gap of 40 odd billion rupees?
So the biggest gap is that of the 90 billion the promoters infused, please don't forget that about 19.5 billion, including the buyback tax, was money paid by Cyber City itself. So hence the net debt will have that adjustment.
Okay, so the buyback amount, you mean the buyback that went from the Cyber City? Okay, and what about the remaining 20 odd billion?
So the real number is 53. So 53 billion is our net debt reduction actually. So of the balance, 17 billion is basically in this quarter composed of whatever 2.5 things, if I may say so. One is that this quarter had the DLF dividend payout of 17-18. B was there was a Cyber City special dividend payout as well, which again to the extent it came to DLF it's fine, but for dividend tax and to the small quantum that it went out to the promoters as a part of the pre-closing activities of Game Changer, that is there. And operationally we had about 1,000 crores deficit, which by and large was give or take 100 crores at pace with what we had been losing in the preceding 2 or 3 quarters. So Rajiv can actually send you the complete Excel spreadsheet on how this entire builds up.
Okay, sir. Okay, thanks for that clarification. And sir, one more question. So we have about 2,500 crore rupees of receivables for our construction activities, and roughly the similar amount for construction spend. So I mean, give or take, there can be mismatches through the quarters and months. But if one takes a 9-month period, then there should not be too much of cash burn before interest payout, but I thought that you said that there should be about 6 to 7 billion rupees of cash burn before interest. So why should there be a cash burn? Because receivables are roughly similar as the pending construction spend.
So when I said 6 to 7 billion before interest, I meant 6 to 7 billion after counting the interest saving of the first tranche that has come in. The fact is, DevCo even today will have about 6,000 odd crores of net debt that continues till the next round of the QIP or whatever the next capital raise happens. That's part A. Part B, you are right that the issue is, and second thing obviously is that the entire outflows towards SG&A, towards any tax payouts, TDSs, some of the minimal capex that keep on happening, some government charges, etc. All of those. So construction is just one part of the cash outflow. So when you're saying that the deficit of say about 2,000 crores between now and the end of the calendar year could happen in DevCo, it includes all of that. And lastly, you yourself, as you rightly mentioned, that while obviously I say across the 18-month cycle, the DevCo and the receivables and the construction will match. Across the 6 or 9 month period, there could be a mismatch, which could itself be in the range of 800 to 1,000 crores of this entire deficit. So I think it's really a combination of these. In all fairness, we also don't have a crystal ball to say what exactly will be the deficit, but we've just been prudent to say that the 900,000 has come down to maybe 600 or 700, but that may still take 3 or 4 quarters before it finally comes down to a zero operating deficit, as we all hope it will be.
Okay, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments. Over to you.
So thank you everybody for the your questions and interactions. We are of course available offline if should you want to have any specific one-to-one interactions and clarifications. Thank you everybody.
Thank you. Ladies and gentlemen, on behalf of DLF Limited, that concludes today's conference call. Thank you for joining us, and you may now disconnect your lines.